Hello students, welcome to E-Pathshala. I am Mrs. P.G. Bhatnagauri, working as Assistant Professor in Avinashlingam University, Coimbatore. Today we are going to discuss the management accounting. The management accounting is used to supply relevant information at appropriate time to the management to enable take the decisions and control. According to Wilson in 1993, encompassing techniques and processes that are intended to provide financial and non-financial information to people within an organization to make better decisions and thereby achieve organizational control and enhance organizational effectiveness is the definition for the management accounting. Accounting is the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by users to use that information. Management accounting. Need for management accounting system. The financial statements have the following limitations: personal judgment or direction. The preparation of financial statement involves a degree of personal judgment or direction that may prevent presentation of facts in their true nature. Take the case of allocating the cost and incomes to a given accounting period. It is very difficult to set a uniform policy to cut off income and cost. It is true that the accounting dependent has considerable direction in this regard. Replacement cost is not emphasized. The financial statements show the assets as per the book value, and these seldom have relevance to the replacement cost. The financial statements are based on the historic cost prices but not the actual prices. Current economic realities ignored. The financial statements presents the accounts on the cost concept. The cost of acquisition of the assets is taken as the basis to present the asset account. These may fare less than the current level of prices, particularly when there is a market decline in the value of currency and the economy shows up inflammatory trends. In other words, an increase in sales revenue may be consequence to the fall in the rupee value and increase in the selling price. It may not be taken care in the financial accounting. Qualitative factors ignored. The financial statements do not reflect qualitative factors such as goodwill, credit rating and so on. These factors have a profound impact on the financial conditions and operating results. However, there are few companies such as Reliance showing up the quality of human factor in their financial statements. Keywords used in management accounting systems. The following are the keywords which we come across while we scan through the management accounting statements. Let us see what they mean to us. Share capital. This is a capital raised by issue of shares. Share capital may be raised by issue of preference share, equity shares or both. Capital is liability of the company. It has to return this to the shareholders at any given time. A shareholder is the owner of the share capital of the company. Preference share capital. This is capital raised by issue of preference shares. Preference shares carry fixed rate of dividend. They get dividend only if the company gets profits. Equity shares. These are also called as ordinary shares. Dividend is not fixed here. If the company got profit, dividend is declared. Otherwise, no dividend. Debentures. This refers to the borrowing by the company. When the company wants additional funds, it may issue debenture. A debenture is the acknowledgement of loan taken to the company. These carry fixed rate of interest. Payment of interest involve a change against the current year profits. Debenture holder is a long-term creditor of the company. Retained profits. These are the accumulated profits over a period of time. These are used for future needs of the business as expansion or acquisition and so on. Long-term loans. These are loans from financial institutions such as banks. Features of management accounting. Internal parties within an organization. Purpose of accounting is non-routine reporting of resource allocation, decision, example, product and cost, emphasis and pricing. Cost planning and control of operations and activities. It is for internal routine reporting. Performance measurement and evaluation of people. Internal non-routine reporting. Meeting external regulatory and legal reporting requirements. It is external reporting. Analysis of accounting statement. Analysis means examining something to know its contents in detail. It is the process of evaluating the relationship between different variables in the accounting statements. The analysis helps to identify the possible remedial measure to strengthen the weak areas of the business. Analysis of accounting statements provides an understanding of the financial matter of business such as following. How is the firm mobilizing resources? How is the firm making profits, losses? How is the firm maintaining its assets and liabilities? How is the firm taking care of liquidity, solvency and profitability of the business and so on? In short, analysis facilitates decision making. Analysis of accounting statements involve an art by itself. It is always desirable that the people involved in the analysis should be conservatives with the nature. This knowledge will help to identify the right type of approach of analysis. There are different approaches for the study of accounting statements. The analysis of the study varies depending upon the users. Either the users are internal or external. Types of analysis. We have horizontal and vertical analysis. Horizontal analysis refers to analysis of accounting statements presented in a horizontal format. Horizontal format of presentation of accounting statements have an advantages of the data relating to different years or different firms for the same year can be given in the comparative basis. It is easy to draw inferences about the relationship between related variables. Vertical analysis. It refers to analysis of accounting statements presented in the vertical format. Vertical format restricts the freedom in presenting the data relating different firms or years for the same firm. The relationship can be drawn for the given period among the variables under study. The concept of common size statement is explained. The internal analysis. The management of the company is interested in finding whether the performance of the company is satisfactory or not during a given period. So, it carries out the financial analysis, or sometimes the job is entrusted to the consultants or specialized agents. The main objective is to identify the strong and weak areas of business. The strategy is to strengthen the weak areas and take advantages of the strength. Internal analysis conducting and using the results of financial analysis by the management for the purpose of forward planning and decision making. The results of internal analysis are not available to outsiders. The users of internal analysis include owners, management and employees. Techniques of accounting analysis. The following are the techniques of financial analysis: ratio analysis, fund flow and cash flow analysis, common size statement analysis, comparative statement analysis, trend analysis. Ratio analysis. It is the process of analyzing and interpreting the accounting statements to explain the issue of liquidity, solvency and profitability based on certain parameters with the help of ratios, proportions, percentage, etc. It is a valuable tool for decision making and forward planning. By using the ratios, the financial performance of the given firm can be analyzed and compared from year to year with that the other firms and even with that of the industry. Funds flow and cash flow analysis. Fund flow analysis deals with the change in the financial position based on flow of fund for a given accounting period. Funds here meaning working capital. Cash flow analysis deals with the changes in the financial position on the basis of cash inflows and cash outflows during the given period. These statements give the information about the movement of funds or cash during given period, and this information is very valuable for forward planning and decision making. This is additional information that is not provided by the traditional statements such as profit and loss account and balance sheet. Common size statement analysis. Given the data or accounting statements of different organizations is the important for common size statement analysis. Common size statement analysis. It is difficult to compare them unless there is a common parameter. Common size statements are those where in the contents of financial statements are converted in terms of common parameter. In profit and loss statements, each item of income and expenditure is expressed as a percentage of sales. In balance sheet, each item of assets and liabilities is expressed as ratio to total assets and total liabilities respectively. Common size statement analysis facilitates inter-firm comparison. Comprehensive statement analysis. Here are compare accounting statements of different years for a given firm to know whether the firm has made any progress over a period of time. This process is also called intra-firm comparison to know whether the performance of the firm is better or not when compared to that of the firms in the same industry. We compare the accounting statements of given firm with those of other firms. This process is called intra-firm comparison. The accounting statements become comparable only when they are arranged in comparative form. Comparison of accounting data. Variances refer to differences between the actual figure and the forecast figure. The comparison involves comparing actual figures with those forecast in the budget produced by the business and circulating the variances. Comparing this year's figures such as cost, sales and profit with those from previous years. Comparing figures from one business with those from other business in the same industry. Comparing actual with forecast. The following is an exact form of sales budget report for a business. It includes sales for the current period and sales for the year so far. Budget control report sales month September 2013 dated 3rd October. The products are product X, Y and Z. We compared the budget value of particular period and actual value and we find the variances. It is compared with the 2 years. This statement reveals that variance of product X in the month of September has been positive and even the trend has on date in this year is favorable. The variance for product Y in the month of September has been negative and the trend as on the date this year is advice. It is exactly here the management of the business would examine the report critically and investigate variances as to the reasons behind the product not doing well and probable situation. Year-to-year comparison. There is a common practice to show the year-to-year trends in the accounting data. For example, the profit figures or sales figure. This enables owners, managers, employees, shareholders and the public to see how the business is progressing. This year-to-year comparison results can be also presented through graphs, bar charts, and so on. Inter-firm comparison. It's also useful to compare performances of the firm with that other firms in the same industry. Such as a comparison helps the owner of the business to see if their business is performing well in comparison to its competitors. Trend analysis. Trend refers to increase or decrease or no change in the performance of given variable under study. For instance, to know whether the software companies are making profit, we cannot draw any meaningful conclusion from the performance of the single company over a single year. It is necessary to study the financial performance of the software company over a last 5 to 6 years to comment about the trend. Financial accounting analyst. Financial analyst, one who analyzes and interprets the financial statement. The financial analyst's job starts where the job of accountant ends. In other words, unless the accountant provides the financial statements, the financial analyst cannot commence his work. The analysis and observations made by the financial analyst is very significant to the creditors, investors, management, government, and so on. The financial accounting analyst should possess a good knowledge of logical reasoning to build relationship between different variables. He should be capable of assessing the impact of different policies of management on the performance of the business. Interpretation is the logical end of the analysis. Analysis with no interpretation has no meaning. Analysis ends with interpretation. It is necessary to focus on issues such as prospects for future earnings, ability to meet short or long-term commitments, portability of the sound investment policy, and so on. And this is possible only through analysis and interpretation of management accounting statements. Accounting records. Management accounting statements give an accounting record facts of business in logical, meaningful way as per requirements of the management. Recorded facts refers to the information obtained from the accounting records. The accounting records furnish the details account of debitors. Debitors buy goods from the firm on credit basis, so they have to pay the firm. Creditors. Creditors supply goods to the firm on credit basis, so the firm has to pay the creditors. Assets. Asset may be fixed asset like machinery or current assets such as cash in hand, so on. Liability. Liability may be a long term like debentures or short term such as bank overdraft. Expenses. What is firm spends on goods, service such as advertising, insurance, wages. Losses. The firm may suffer losses such as loss, stock in fire, etc. Income. The firm earns interest on investment, receives rent, commissions, so on. Profits. The firm may profit on selling the goods. Gain. The firm makes gain on sale of fixed assets such as plant or land and buildings. Distinguish between financial accounting and management accounting. The key factors are nature of reports. Financial accounting is general specific amount of details, while the management accounting have the detailed board overview considerable. Regulations. Financial accounting subject to accounting regulations. Management accounting no specific regulations. Reporting interval. Financial accounting annual frequency as required horizon. Management accounting time backward and forward. Range and quality of information. Financial accounting quantifiable information in monetary terms. Here financial and non-financial information are provided. To conclude, management accounting, it is used to describe the activities of managers in short run and long run planning and control of cost. It is also include the continuous reduction of cost. It is the key part of general management strategies and their implementation. Management accounting formulate plans to different activities and coordinate plans into budget for business as a whole controlling. It produces performance reports that compare actual outcomes with planned outcomes. Management accounting develops accounting reporting systems that are closely related to organizational structure. Management accounting providing guidance for decision making and problem solving in order to achieve optimum results or maximize investors' values. Finally, it is used to aid the communication functions by installing and main training and effective communication and reporting system. Example, budget and performance reporting process. Thank you.